Here's what you're about to see. A single mom with $12,000 in credit card debt transforms her finances and builds a $250,000 portfolio in 7 years. A 31-year-old delivery driver who never made more than $45,000 a year creates enough passive income to work part-time. And a teacher who lost everything in 2008 rebuilds his wealth to retire 5 years early. I'll break down their exact strategies, the psychological techniques they use to stay consistent, and the specific investments that generated the biggest returns. No get-rich-quick schemes, just practical, proven approaches that worked for people who were once sitting exactly where you are right now. Meet our investment heroes, 3 ordinary people with extraordinary results. Did you know that 77% of Americans feel anxious about investing? That statistic might make you feel a little better if you've been hesitant to jump into the market. But here's the thing. While most people let that anxiety stop them, there are ordinary folks who push through it and build serious wealth anyway. Today, I'm introducing you to 3 of these investment heroes who started exactly where you might be right now. Let's meet Charlotte, Marcus, and David, 3 regular people who transformed their financial lives without fancy degrees in finance or wealthy parents bankrolling their first investments. Charlotte was a single mom working as an administrative assistant, making about $38,000 a year while supporting 2 kids. When her investment journey began, she was drowning in $12,000 of high-interest credit card debt with absolutely zero savings. Every month was a struggle to make ends meet, and the thought of investing seemed completely out of reach. Fast forward to today, and Charlotte has built a portfolio worth over $250,000 while completely eliminating her debt. Then there's Marcus, a delivery driver earning just under $45,000 annually. He was living paycheck to paycheck in his early 30s with no college degree and no financial safety net. The idea of financial freedom seemed like a distant dream for someone in his position. Yet by age 38, Marcus had generated enough passive income from his investments to scale back to part-time work, giving him the freedom to pursue his other passions. Our third hero is David, a high school teacher who experienced the devastating blow of losing his entire retirement savings during the 2008 financial crisis. His 401k was decimated, his house was underwater, and at age 45, he felt like he was starting from scratch. The experience left him financially and emotionally broken. Despite this catastrophic setback, David managed to rebuild his portfolio and retire 5 years earlier than planned with 7 figures in his investment accounts. What makes these stories so compelling isn't just the impressive numbers. It's that Charlotte, Marcus, and David achieved these results without any special advantages. They didn't have insider knowledge, wealthy connections, or unusual opportunities. They were working regular jobs with ordinary salaries in typical American cities. They didn't inherit money, win the lottery, or get lucky with a hot stock tip. Look at your own situation right now. Maybe you're juggling bills and wondering how you could possibly have money left over to invest. Perhaps you've tried investing before but got burned, and now you're skeptical about trying again. Or maybe you're completely new to investing and feel overwhelmed by all the conflicting advice out there. I'd bet that at least one of our investment heroes started in circumstances very similar to yours. What's truly fascinating about these 3 success stories is that they didn't rely on extraordinary market timing or get-rich-quick schemes. They didn't need to become day traders glued to stock charts or real estate moguls flipping houses. Their methods were accessible and replicable, built on principles that anyone can apply regardless of their current financial situation. So what separated these 3 from the millions of Americans who remain on the investment sidelines? It wasn't that they had more money to start with. It wasn't that they were smarter than everyone else. And it definitely wasn't that they had some secret formula for picking winning stocks. The difference came down to their approach. While most people were looking for shortcuts or waiting for the perfect time to invest, Charlotte, Marcus, and David developed systems that worked with their unique situations. They created personalized investment frameworks that addressed their specific challenges, whether that was limited income, psychological barriers, or recovering from financial trauma. What's especially interesting is how they each handled market volatility. When stocks were plummeting and financial news headlines were screaming doom and gloom, these 3 didn't panic sell like so many others. They had developed strategies specifically designed to weather market storms, and in some cases even take advantage of them. For Charlotte, Her journey began with just $25 weekly automatic transfers to an investment account, an amount many financial experts would dismiss as too small to matter. Marcus implemented what he called a 1% investment ladder that gradually increased his savings rate without disrupting his tight budget. And David created a recovery portfolio specifically designed to help him overcome the financial PTSD he experienced after 2008. These aren't the kinds of strategies you typically hear about from Wall Street gurus or financial influencers promising overnight riches. They're methodical, sustainable approaches built for regular people with real-world constraints and challenges. Throughout this video, I'll break down exactly how each of these investment heroes transformed their financial situations step by step. You'll see the specific tools they used, the psychological barriers they had to overcome, and the exact strategies they implemented at each stage of their journey. I'll show you how Charlotte managed to tackle her high-interest debt while simultaneously starting to invest. A move that contradicts some conventional financial advice, but proved incredibly effective in her situation. You'll learn about Marcus's dividend tracking system that outperformed many paid services, and David's counterintuitive crash fund that turned market downturns into opportunities. The beauty of these three stories is that they offer different paths to investment success based on your starting point and personal circumstances. If you're struggling with debt like Charlotte was, her approach might resonate most. If you're working with a modest income like Marcus, his gradual system might be your blueprint. And if you've experienced financial trauma like David, his recovery strategy could be exactly what you need. What's particularly valuable about these case studies is that they span different age groups, income levels, and life situations. Charlotte was in her early 30s when she began, Marcus started at 31, and David was rebuilding in his mid-40s. This demonstrates that it's never too early or too late to change your financial trajectory. As we dive into each case study, pay special attention to the psychological aspects of their journeys. All three had to overcome significant mental barriers around money and investing, fears, doubts, and anxieties that probably sound very familiar to you. The techniques they developed to manage these psychological challenges were just as important as their investment strategies. What surprising investment strategies did these three ordinary people use to build wealth? That's what we'll explore throughout this video. We'll examine exactly how they transformed from financial zeros to investment heroes, breaking down their approaches into clear, actionable steps that you can apply to your own life. Case study number 1. The single mom who turned $12,000 debt into $250,000. Let's start with Charlotte, whose story might completely change how you think about investing with limited resources. Would you believe her six-figure portfolio began with just $25 a week, an amount many financial advisors would dismiss as too small to make any real difference? Charlotte's journey began at what she calls her financial rock bottom. After avoiding her bank statements for months, she finally sat down one evening after putting her kids to bed and faced the harsh reality of her finances. What she saw made her physically ill. Not only was she $12,000 in credit card debt, but she had been paying only minimum payments, essentially throwing money away on interest. I remember sitting at my kitchen table at 11 p.m., calculator in hand, realizing that at the rate I was going, I'd be paying off this debt for the next 15 years, Charlotte recalls. Something just snapped in me that night. I knew I had to make a drastic change, not just for me, but for my children's future. The breaking point came when Charlotte calculated that she was paying nearly $250 monthly just in interest on her credit card debt, money that was simply disappearing. This realization hit her hard, especially when she thought about what that money could do for her children's education or their quality of life. With two young children depending solely on her administrative assistant's salary, Charlotte knew she needed a plan that would both eliminate her debt and build financial security. Most financial advice Charlotte found online followed a strict sequence. Pay off all debt first, then start investing. But Charlotte took a different approach after reading about the opportunity cost of delaying investments. I realized that waiting 3 to 4 years to start investing meant losing those years of potential growth forever. I couldn't get that time back. Charlotte's unconventional strategy involved a two-pronged approach. First, she restructured her debt using a balance transfer offered to a card with 0% interest for 18 months. This immediately freed up the $250 she had been paying in interest. Instead of using all of that money for faster debt repayment as most advisors would suggest, she split it strategically. She accelerated her debt payments with $200 of the freed-up money, while simultaneously directing $50 per week toward investments. $25 from her original budget and $25 from the money she saved on interest. My friends thought I was crazy to invest while still having debt, but I ran the numbers and saw that the long-term benefit outweighed the short-term cost, especially with the 0% interest period. What made Charlotte's approach particularly effective was her use of automation. She set up her investment account to automatically withdraw $25 every Friday payday, before she could spend it on anything else. She chose this frequency deliberately, knowing that weekly investments would give her more exposure to market fluctuations than monthly investments, potentially lowering her average purchase price over time. The automation was key, Charlotte explains. I never saw the money, so I never missed it. And starting with just $25 weekly meant it didn't impact my budget enough to tempt me to cancel it when things got tight. When Charlotte approached a financial advisor with her plan, she was discouraged. He told me not to bother with such small amounts, that $25 a week wouldn't make any meaningful difference to my future, and I should focus entirely on debt repayment. Fortunately, Charlotte ignored this advice and continued her parallel approach. As Charlotte paid down her credit card debt, she implemented what she calls her debt-to-wealth pipeline technique. Every time she paid off a credit card or loan, she would immediately redirect a portion of those former debt payments into her investment account before her budget could absorb the freed-up money. This gradual approach allowed her to increase her investment contributions without feeling the pinch. When I paid off my first card, which had a $120 monthly payment, I immediately set up an additional $60 weekly transfer to my investment account. My budget never adjusted to having that money available for spending, so I never missed it. This incremental approach allowed Charlotte to steadily increase her investment contributions from $25 weekly to $50, then $85, and eventually to $150 per week as her debt disappeared. By the time she had completely eliminated her credit card debt 3 years later, Charlotte was investing nearly $600 monthly and had already accumulated a portfolio worth over $15,000 despite starting with almost nothing. What's particularly remarkable about Charlotte's investment journey is that it occurred during one of the most volatile market periods in recent history. Between 2016 and 2023, the market experienced dramatic swings, including the pandemic crash of 2020. While many investors panicked and sold during downturns, Charlotte maintained her consistent weekly investments regardless of market conditions. I actually increased my contributions during market drops when I could afford to, Charlotte says. I saw those periods as sales on stocks, not reasons to panic. Charlotte's commitment to regular, automatic investments regardless of market conditions led to a phenomenon known as dollar-cost averaging, where she naturally bought more shares when prices were low and fewer when prices were high. This approach turned market volatility from an enemy into an ally. The power of Charlotte's approach became evident during the pandemic market crash of 2020. While many investors saw their portfolios plummet and panicked, Charlotte viewed the situation differently. She had been investing consistently for years by this point and had built a solid foundation. Rather than selling in fear, she maintained her automatic investments and even directed her entire stimulus check into the market when prices were significantly down. This counterintuitive move, investing more during a time of uncertainty, paid extraordinary dividends as the market recovered and then surged in the following years. These shares purchased during the downturn became some of the most valuable assets in her portfolio as they appreciated significantly during the recovery. What makes Charlotte's story even more relevant is that she didn't use any complex investment strategies or high-risk approaches. She primarily invested in low-cost index funds that provided broad market exposure, reinvested all dividends automatically, and simply maintained her consistent contributions regardless of market conditions or economic news. Many online brokers helped make Charlotte's strategy possible by eliminating minimum account requirements, allowing her to start with small weekly deposits that many traditional advisors would have dismissed as insignificant. These accessible investment platforms democratized investing for people like Charlotte, who couldn't meet the high minimums that were once common in the industry. The results speak for themselves. Through consistent contributions that gradually increased as her debt decreased, Charlotte built a substantial investment portfolio while simultaneously eliminating her debt burden. Her disciplined approach to funneling money from debt payments directly into investments created a powerful wealth-building engine that gained momentum over time. But how did Charlotte maintain this discipline when many others would have given up? What psychological techniques helped her stay the course during market volatility, especially with so little investing experience and no financial safety net? The psychology of investing. How our heroes overcame fear and doubt. Behind Charlotte's remarkable investing consistency lay a psychological system that transformed her relationship with money. What these three everyday investors discovered about their emotions may be more valuable than any stock pick. They each developed unique mental frameworks that financial experts rarely discuss, but neuroscience strongly supports. Their stories reveal something fascinating. Successful investing has less to do with financial knowledge and much more to do with managing your mind. Financial education alone turns out to be surprisingly ineffective at creating successful investors. Think about it, plenty of finance professors and Wall Street analysts with encyclopedic market knowledge still make terrible investment decisions with their own money. Why? Because investing is fundamentally an emotional challenge disguised as a mathematical one. Each of our three investment heroes initially fell into classic psychological traps. Charlotte experienced intense loss aversion. The fear of losing money was emotionally twice as powerful as the pleasure of gaining it. Our delivery driver struggled with recency bias, giving too much weight to whatever had happened in the markets most recently. And our teacher? Classic confirmation bias, only seeking out information that matched his existing pessimistic outlook after 2008. Let's look at how Charlotte tackled her investment anxiety, because her approach was remarkably effective. She developed what she called a feelings versus facts journaling system. Every time she felt nervous about the market or tempted to change her investment strategy, she would take out her journal and create two columns. In the feelings column, she'd write exactly what she was experiencing emotionally. I'm scared the market will crash and I'll lose everything. Or everyone's talking about this new tech stock and I feel like I'm missing out. Then in the facts column, she'd write only verifiable information. My time horizon is 25 plus years, or historical data shows markets eventually recover. This simple act created psychological distance between her emotions and her decision-making. By acknowledging her feelings while separating them from facts, she could recognize when fear or greed was driving her impulses. The brilliance of Charlotte's system was that it didn't deny emotions. It simply prevented them from hijacking rational decisions. The delivery driver took a completely different approach to overcome what many investors struggle with: financial imposter syndrome. That persistent feeling that everyone else knows what they're doing while you're just faking it. His solution: community accountability. Rather than hiding his investment journey, like most people do, he intentionally shared his progress, mistakes and all, with a small group of like-minded investors. When he made an emotional decision he regretted, he'd discuss it openly. When he was tempted to panic sell during a downturn, he'd message the group first. This approach completely reframed failure. Instead of seeing investment mistakes as shameful evidence he didn't belong in the market, they became valuable learning experiences to share with others. The psychological relief was immense. He no longer needed to project an image of perfect investing knowledge, which paradoxically made him a far better investor. The teacher's psychological approach was perhaps the most counterintuitive of all. After being traumatized by his 2008 losses, he developed what financial advisors might consider heresy: a selective ignorance strategy. While most investment advice centers on staying informed, he discovered that certain types of information actually harmed his decision-making. He stopped watching financial news channels entirely. He checked his portfolio value only quarterly instead of daily. When markets dropped significantly, he deliberately avoided reading explanations about why. This wasn't burying his head in the sand. It was strategic information filtering. His approach aligns with fascinating research showing that investors who check their portfolios less frequently actually achieve better returns. The constant flow of market commentary creates an illusion of needing to react, when the most profitable strategy is often to maintain course. By selectively ignoring short-term noise, the teacher could focus on long-term trends that actually mattered to his timeline. What's remarkable is that all three investors, despite their different approaches, utilized visualization techniques backed by behavioral finance research. They each created vivid mental pictures of their future financial goals. Not just abstract numbers, but detailed images of what financial security would look like and feel like in their lives. Charlotte visualized the day she'd tell her children their college education was fully funded. The delivery driver imagined the morning he'd wake up and choose whether to work that day. The teacher pictured the exact moment he'd clean out his classroom desk for the last time, years ahead of schedule. Neuroscience research shows these specific visualizations actually strengthen neural pathways associated with long-term planning and delayed gratification. When market volatility triggered fear, these mental images provided emotional counterweight, a clear reminder of why short-term discomfort was worth enduring for long-term success. Each investor experienced an unexpected psychological breakthrough that transformed their relationship with investing. For Charlotte, it was the surprising realization that she felt more financially secure with a modest, growing investment account than she had with seemingly safe cash in the bank. The delivery driver discovered that sharing his investment failures with others didn't result in judgment, but in deeper connections and better decisions. And the teacher found that his investment confidence grew not from consuming more information, but from being selective about which information actually deserved his attention. Their experiences point to a crucial truth. The psychological barriers that nearly derailed their investment journeys weren't unique to them. Loss aversion, analysis paralysis, confirmation bias. These are universal human tendencies. The difference was developing personalized systems to manage these emotional challenges, rather than pretending they didn't exist. This psychological dimension of investing explains why so many people with substantial financial knowledge still struggle to build wealth. They focus exclusively on questions like, which fund has the lowest expense ratio? When they should be asking, busting the "you need money to make money" myth. While psychology plays a crucial role in investment success, there's another massive roadblock that keeps countless potential investors on the sidelines: the persistent belief that you need money to make money. But what if I told you our 3 ordinary investors started with amounts so small that most financial advisors would have laughed them out of the office? This myth, that you need a substantial chunk of cash to start investing effectively, is perhaps the most damaging misconception in personal finance. It paralyzes people into waiting for some magical someday when they'll finally have enough to begin. But our 3 case studies demolish this idea completely. Remember the starting points? $25 per week, $50 per month, and just $10 per day. These aren't amounts that would impress anyone at a cocktail party. They're coffee money, lunch money, the spare change you might find between your couch cushions. Yet these seemingly insignificant amounts were the foundation of impressive financial transformations. Let's break down the math that makes this possible. If you invest just $10 daily, like our delivery driver did, that's about $300 monthly or $3,650 annually. At a 7% average annual return, after 5 years you'd have over $21,000, with only $18,250 actually coming from your pocket. The remaining $2,750 plus came from compound growth. After 10 years, that same $10 daily habit grows to nearly $52,000, with almost $16,000 of that being investment returns. The numbers reveal something powerful. Time in the market dramatically amplifies even tiny contributions. Our teacher found this out when he ran calculations comparing 2 hypothetical investors. The first investor waited 10 years until they had $10,000 to invest all at once. The second investor started immediately with just $50 monthly. After 30 years, the early starter with small amounts ended up with significantly more money despite investing less out of pocket. What's particularly fascinating is how the delivery driver leveraged modern micro-investing platforms to accumulate his first $10,000. These platforms have revolutionized access to investing by eliminating minimum investment requirements altogether. With just $5, he could start building positions in quality investments, something that would have been impossible just a decade ago. He described his strategy as invisible investing, setting up automatic transfers so small he barely noticed them missing from his daily budget. Every coffee purchase rounded up to the nearest dollar, with the difference flowing into his investment account. Every paycheck had a small percentage automatically diverted before he could spend it. These micro amounts added up surprisingly quickly. Within 18 months, these small, consistent investments had grown to his first $10,000, a psychological milestone that completely transformed his relationship with money. What started as an experiment became undeniable proof that small, consistent actions could create meaningful results. The teacher's approach was slightly different, but equally effective. Having learned painful lessons from 2008, he developed what he called a percentage-based investment strategy. Rather than fixating on dollar amounts, which often felt discouragingly small compared to what he'd lost, he focused on percentages of his income. He started by investing just 3% of his teacher's salary, an amount that felt almost trivial. Every 6 months, he increased that percentage by just 1%. This gradual approach meant he never felt the financial pinch that causes many budding investors to abandon their plans. By the time he reached 15% of his income several years later, investing had become completely automatic, both financially and psychologically. What's particularly remarkable about these approaches is how they bypass the common objection of, "I don't have enough to invest." They prove that the minimum effective investment amount isn't some impressive lump sum. It's whatever you can consistently contribute over time. The key insight here is that investing success comes not from having large sums to start with, but from consistency over time. Our 3 investors discovered that the math of compounding works exactly the same way whether you're starting with $25 or $25,000. The critical factor is giving your money enough time to grow. This realization was transformative for all 3 of our investment heroes. They each described a specific moment when they first saw meaningful growth in their accounts, a moment that changed everything. For the delivery driver, it was logging into his investment app and seeing his balance hit 5 figures for the first time. He recalled pulling over in his delivery van and just staring at the screen in disbelief. What started as an experiment had become undeniable proof that he could build wealth without a high-paying job or inherited money. The teacher experienced his breakthrough when he realized his small, consistent investments had recovered approximately 30% of what he'd lost in 2008, and it had happened almost without his noticing. This quiet progress, accumulated through modest but unwavering contributions, gave him the confidence to continue and eventually surpass his previous financial position. The micro-investing approach proved particularly powerful because it eliminated almost all barriers to entry. Our case studies didn't need to save up a minimum investment amount. They didn't need to navigate complex brokerage account applications. They didn't need to make high-stakes decisions about where to invest large sums of money. Instead, they could start immediately, with amounts so small they barely impacted their daily lives. This approach transformed investing from something big and intimidating into something manageable and accessible. What's particularly effective about starting small is how it creates a foundation for behavioral consistency. When you begin with tiny amounts, the psychological pressure is minimal. You can make mistakes, learn, and adjust without significant consequences. This creates the space to develop the habits and knowledge that will serve you when larger sums are involved. Our delivery driver explained it best. Starting with $10 a day meant I could focus on building the habit without stressing about performance. By the time my investments grew to a meaningful amount, I'd already worked through the emotional roller coaster and developed confidence in my approach. This principle applies universally. Whether you're a single parent juggling childcare expenses, a delivery driver with unpredictable income, or a teacher rebuilding after financial disaster, the power of small, consistent investments remains the same. The math doesn't discriminate based on your income level or starting point. The reality is that most wealth isn't built through sudden windfalls or get-rich-quick schemes. It's built through mundane, consistent actions maintained over time. Our 3 investors proved that you don't need to wait for some magical moment when you'll have enough to start. The best time to start is always now, with whatever you have. Case study number 2. How a delivery driver built financial freedom on $45,000 per year. Those small, consistent actions we just discussed are exactly what transformed Marcus's financial life. Unlike many people who wait for some perfect financial moment, this delivery driver discovered that wealth building starts with whatever you have right now. At age 31, Marcus had no college degree and worked hourly routes delivering packages across the city. His $45,000 annual salary covered basic expenses, but left little room for extras. Like many Americans, he lived paycheck to paycheck, with his bank account routinely hovering near zero before each payday. Then came the breaking point. Marcus's car, essential for his side gigs, broke down completely. The $2,200 repair bill might as well have been $22,000. He had exactly $0 in savings. Forced to put the entire amount on a high-interest credit card, Marcus realized something had to change. I remember sitting in that mechanic's waiting room, watching my financial future disappear with each swipe of my credit card, Marcus told me. That was my wake-up call. I was in my 30s with nothing to show for it. This financial emergency sparked Marcus's investment journey, but his approach was refreshingly practical. Rather than making dramatic financial promises to himself that would be impossible to keep, he began with the 1% investment ladder strategy. The concept was simple. Start by investing just 1% of his income, then increase by an additional 1% every few months as he adjusted to living on slightly less. This gradual approach made the process psychologically manageable. The first 1% was barely noticeable, about $18 from each biweekly paycheck. When that became comfortable, he bumped it to 2%, then 3%, and continued climbing. The beauty of the latter approach was that I never felt deprived, Marcus explained. Each small increase gave my brain time to adapt to the new normal. By the time I reached 15% 2 years later, it didn't feel like a sacrifice anymore. But where most beginning investors might have stopped at simply choosing a target date fund or basic index fund, Marcus developed a fascinating investment focus that perfectly matched his personality: dividend growth stocks. Why dividends? Marcus discovered he was motivated by seeing tangible results. While most forms of investing require patience before seeing meaningful growth, dividend investing provided regular paycheck-like deposits into his account from day one. Getting those dividend payments every month or quarter gave me instant feedback that my money was working, Marcus said. Even when they were tiny at first, like $1.87, seeing companies pay me felt incredible. It was like having little employees working for me, 24/7. This psychological boost kept him consistent when many others would have quit. He became fascinated with companies that had histories of not just paying dividends, but increasing them year after year. These weren't get-rich-quick stocks, but steady businesses with decades-long records of sharing profits with shareholders. Without a finance background, Marcus needed a straightforward research system. He developed what he called his 3Ds approach to finding quality dividend companies. First, duration. He looked for companies with at least 10 consecutive years of dividend increases, which demonstrated financial stability through different economic conditions. Second, debt. He avoided companies with excessive debt that might jeopardize future dividend payments. Third, diversification. He ensured his holdings spanned multiple sectors to protect against industry-specific downturns. This simplified framework allowed him to evaluate potential investments without getting overwhelmed by complex metrics or trying to time the market. He focused on buying shares in about 20 solid companies that collectively paid him dividends in every month of the year. What made Marcus's approach particularly effective was his core and explore portfolio construction method. This strategy provided both stability and growth potential by dividing his investments into two distinct categories. The core portion, about 70% of his portfolio, went into stable, diversified investments like dividend-focused ETFs and blue-chip companies with long histories of increasing payments. This foundation provided reliability and steady growth. Meanwhile, the explore portion, the remaining 30%, went toward higher growth opportunities that still paid dividends but had more appreciation potential. This smaller allocation allowed him to pursue potentially higher returns without endangering his overall financial security. The core and explore strategy gave me the best of both worlds, Marcus explained. The core kept me sleep at night, while the explore portion gave me something to get excited about. It was like having a responsible savings account that still let me take calculated risks. By his mid-30s, Marcus's dividend portfolio was generating about $380 monthly. Not enough to quit his job, but a meaningful supplement that accelerated his financial progress. He reinvested every penny, creating a powerful snowball effect as his dividends purchased more shares, which in turn generated more dividends. The most remarkable aspect of Marcus's approach wasn't just his investment selection, but his unwavering consistency. He continued his regular investments through every market condition, including some significant downturns. I never tried to time the market, he explained. I just kept buying quality companies whether they were up or down. Sometimes I'd get excited when prices dropped because I knew I was getting better values and higher dividend yields. By his late 30s, Marcus's dividend portfolio had grown to generate over $1,800 monthly in passive income, enough that he could reduce his delivery routes and work part-time. The financial freedom didn't happen overnight, but through consistent application of his strategy over 7 years. What's especially powerful about Marcus's approach is that it never required a large lump sum or high income. It worked specifically because he started small and remained disciplined, proving that ordinary incomes can produce extraordinary results when paired with the right strategy and mindset. Every month, as dividend payments arrived in his account, Marcus saved the confirmation emails. Looking at that growing folder of payment notifications became my motivation, he said. Each one was proof that my money was working for me even while I slept. But his investment journey wasn't without challenges. As his portfolio grew larger, Marcus faced increasing pressure to make changes. Friends suggested cryptocurrency, others pushed real estate. Financial news headlines constantly warned of impending crashes. The hardest part wasn't starting. It was sticking with my boring, consistent approach when everyone else seemed to be getting rich quicker with flashier investments, Marcus admitted. I had to repeatedly remind myself that slow and steady actually works. Then came the ultimate test, the market crash of 2020. In just a few weeks, Marcus watched his portfolio drop by nearly 35% on paper. Many investors panicked and sold everything, but Marcus took a different approach. The tech tools that gave our heroes an edge. When the market crashed in 2020, Marcus didn't panic sell like so many others. That's because he had something most investors lacked. A personalized tracking system that gave him confidence when emotions were running high. The truth might surprise you. While Wall Street wants you to believe you need expensive algorithms and premium subscriptions to succeed, our 3 everyday investors discovered that. Free digital tools provided an edge many professionals couldn't match. The financial industry has perpetuated this myth that successful investing requires sophisticated software costing thousands per year or professional management charging hefty fees. It's a convenient narrative that keeps many people intimidated and dependent on expensive services. But our 3 investment heroes discovered a completely different reality. I thought I needed to pay for some fancy investing platform, Charlotte admitted. But the tools that actually transformed my finances were completely free. This revelation didn't just save her money. It fundamentally changed her approach to building wealth. Each of our 3 investors leveraged different technological solutions that aligned with their specific investment strategies and psychological needs. These weren't complex systems requiring coding knowledge or financial degrees. They were accessible tools anyone could master within a few hours. Charlotte's breakthrough came through automation. Rather than relying on willpower to invest consistently, she utilized free features in her brokerage account to create an ironclad system. She set up automatic transfers that pulled money from her checking account the day after each paycheck landed, making investing non-negotiable. The automatic investing feature was my secret weapon against myself, Charlotte explained. On days when I felt anxious about the market or tempted to spend that money, the decision was already made for me. This simple automation eliminated countless opportunities for self-sabotage and emotional decision-making. She took automation a step further by using free notification tools to create what she called her investment blackout periods. During market volatility, she would activate these settings to block investing apps from her phone for predetermined time periods, preventing panic selling during downturns. This digital guardrail protected her from her worst instincts exactly when protection was most needed. For Marcus, the game changer was an ordinary spreadsheet. While many investors pay hundreds annually for dividend tracking services, Marcus built his own customized tracking system using free spreadsheet software. This wasn't just about saving money. His personalized system actually outperformed many paid alternatives. His dividend tracking spreadsheet evolved into a comprehensive dashboard that gave him insights many expensive services missed. He created visualization features showing his monthly passive income growth, dividend increase history for each holding, and projected income for the next 12 months. Having this personalized data at his fingertips provided clarity during market turbulence. When everyone was panicking during the crash, Marcus recalled, I opened my spreadsheet and saw that my dividend income had actually increased that month despite stock prices falling. That single insight kept me from making a catastrophic selling mistake. The power of Marcus's approach highlights an often overlooked financial reality. Dividend tracking spreadsheets can help investors monitor their income and performance with remarkable precision, allowing for more informed decisions than many paid services provide. His customizable tracking options gave him insights specifically tailored to his investment goals. David, our teacher who rebuilt after losing everything in 2008, took yet another approach. His technological edge came through visualization tools. After his devastating losses, David struggled with investment anxiety that threatened to keep him permanently on the sidelines. His solution was using free portfolio visualization software that transformed abstract numbers into meaningful visual patterns. Seeing my portfolio visually rather than just as numbers changed everything, David explained. The charts showed me that despite short-term volatility, the long-term trend was consistently upward. These visual representations spoke to a different part of his brain than raw numbers, helping him maintain discipline during market fluctuations. David also discovered free retirement calculators that allowed him to run unlimited scenarios with different variables. Unlike the basic calculators most people use, David's approach involved running hundreds of simulations with different market conditions, savings rates, and retirement dates. This Monte Carlo-style analysis gave him confidence that his plan was robust even under adverse conditions. What's particularly striking about all three investors is how they combine these technological tools with free educational resources. Rather than paying thousands for investment courses, they curated their own financial education through carefully selected podcasts, YouTube channels, and library books. Charlotte created what she called her Financial MBA playlist, a collection of expert interviews and educational content she listened to during her commute. Over time, this free education gave her knowledge rivaling many paid financial advisors. Marcus joined online communities where investors shared dividend strategies without the sales pitches that come with professional advice. David relied on academic research papers available through his school's library access. Perhaps the most surprising technological advantage came through their creative use of reminder systems. All three investors programmed regular prompts into their calendars that went beyond simple alerts. Marcus set quarterly reminders containing his original investment thesis for each holding, preventing him from making emotional decisions contrary to his initial research. Charlotte created calendar entries on the anniversary of market crashes containing a single message: "This too shall pass." The financial literacy gap remains a significant challenge in America, with research showing approximately 50% of U.S. adults lack essential financial knowledge. This gap underscores the crucial role that accessible technological tools play in democratizing investment success. By utilizing free resources, our three investors closed their personal financial literacy gaps without expensive education. What these investors discovered contradicts the prevailing wisdom that financial success requires costly tools. In fact, sometimes the simplest technologies produce the most powerful results. The spreadsheet Marcus used to track dividends cost him nothing, but gave him insights that kept him invested during market turbulence when many professionals were recommending selling. This doesn't mean all free tools are created equal. Each investor went through a period of experimentation before finding the technological solutions that worked for their specific needs. Charlotte tried 5 different budgeting apps before finding one that matched her thinking style. Marcus initially borrowed spreadsheet templates from online forums before creating his own custom version. The greatest technological advantage these investors shared wasn't any specific app or platform. It was their systematic approach to using technology intentionally. They didn't allow tools to dictate their strategy. Instead, they selected and customized tools that supported their carefully considered plans. The technology didn't make my investment decisions, David emphasized. It gave me the data and perspective to make better decisions myself. This distinction highlights the difference between passive consumption of financial technology and active utilization. Perhaps the most counterintuitive insight is how these investors use technology to protect themselves from technology. In an age of constant financial news and market updates, they created digital boundaries that shielded them from information overload. David used website blockers during market downturns to prevent financial news sites from triggering his anxiety. Charlotte scheduled offline investment review days, where she evaluated her strategy away from screens and notifications. The tools that made the biggest difference weren't necessarily the most sophisticated ones. Sometimes the most powerful technological edge came from simple applications used consistently over time. Marcus's spreadsheet evolved through hundreds of small improvements rather than radical redesigns. Charlotte's automation systems succeeded through their reliability rather than their complexity. What's truly remarkable is how these everyday investors often surpass the performance of professionals with expensive software packages. By focusing on tools that address their specific psychological vulnerabilities and investment approaches, they created systems perfectly. Case study number 3. The teacher who rebuilt after losing everything in 2008. The financial devastation of 2008 hit some harder than others, but David's story reveals an extraordinary comeback that proves resilience can be your greatest investment asset. Could you rebuild your entire financial life after watching decades of careful saving vanish almost overnight? For David, a high school history teacher approaching his mid-40s, this wasn't a hypothetical question. It was his harsh reality. When the housing market collapsed, David's modest suburban home plummeted to 40% below what he owed on his mortgage. Simultaneously, his retirement portfolio, which he'd proudly built over 20 years of teaching, lost nearly 70% of its value in a matter of months. The financial security he'd worked his entire career to build evaporated before his eyes. I remember sitting at my kitchen table with bank statements spread out, calculating how many extra years I'd need to work just to get back to where I started, David recalled. The math was so depressing, I just stopped checking my accounts altogether. The psychological impact was devastating. David didn't just lose money. He lost confidence in the entire financial system. For 3 years following the crash, he avoided investing completely. His contributions to his school district's 403b plan sat in cash, earning practically nothing while inflation slowly eroded its value. I couldn't face losing everything again, he explained. Every news headline about market volatility would trigger this overwhelming anxiety. I'd literally feel physically ill thinking about putting money back into stocks. What makes David's story remarkable isn't just his eventual financial success. It's the psychological journey he undertook to rebuild his relationship with investing. After 3 years of financial paralysis, a conversation with a colleague who had survived similar losses became his turning point. She told me something that changed everything, David said. She said, "The market has taken your money, but don't let it take your future too." That hit me hard. David's re-entry to investing wasn't the traditional approach financial advisors typically recommend. He created what he called his recovery portfolio, specifically designed to address the financial trauma he'd experienced. Rather than immediately jumping back into aggressive growth investments, he prioritized psychological comfort over theoretical optimization. Every investment decision I made had to pass what I called my sleep test, David explained. If the investment would keep me up at night worrying, it wasn't worth it, no matter what the potential return. This led David to develop his signature 3-bucket investment system. Rather than viewing his portfolio as one unified entity, he mentally and practically separated his investments into 3 distinct categories: growth, income, and preservation. The preservation bucket contained conservative investments like high-quality bonds and cash equivalents, assets that would maintain value even during market volatility. This wasn't just about financial preservation, it was emotional preservation. Having this secure foundation allowed David to gradually rebuild his risk tolerance. The income bucket focused on investments that generated reliable cash flow, dividend-paying stocks, REITs, and fixed income securities. Unlike his previous approach of focusing primarily on growth, David found psychological comfort in seeing tangible returns regularly appear in his account. The growth bucket, which eventually became the largest portion of his portfolio, was where David allocated funds to long-term appreciation investments, primarily low-cost index funds tracking the broader market. But he approached this bucket differently than before the crash. "I needed to change my relationship with market volatility," David explained. "Instead of seeing downturns as disasters, I needed to view them as opportunities." This mindset shift led to perhaps his most brilliant strategy, the creation of what he called his crash fund. Unlike emergency funds that sit idle waiting for life emergencies, David's crash fund was specifically designed to capitalize on market downturns. I set aside about 10% of my portfolio in cash, not for emergencies, but specifically to invest when the market dropped significantly, he explained. It completely changed my psychology. Instead of dreading market crashes, I started to see them as sales, opportunities to buy quality investments at discount prices. The crash fund served dual purposes. It provided psychological security, knowing he had cash available if needed, while simultaneously positioning him to benefit from market volatility rather than fear it. When markets dropped by predetermined percentages, usually 10%, 15%, and 20%, David would automatically deploy portions of his crash fund to purchase more shares at lower prices. This approach transformed market downturns, from periods of anxiety into moments of opportunity. During the flash crash of 2015, when markets briefly plunged, David deployed 30% of his crash fund, purchasing index funds at steep discounts. When markets recovered months later, those purchases had already appreciated significantly. Having a specific plan for market drops eliminated the panic. I wasn't making emotional decisions in the moment. I was simply following my predetermined strategy, he said. The three-bucket system with his crash fund strategy proved remarkably effective during subsequent market corrections. In December 2018, when markets dropped nearly 20%, David had already prepared mentally and financially. Rather than panic selling like many investors, he systematically deployed his crash fund according to his plan, purchasing quality investments at discount prices. What truly distinguished David's approach was how he tailored traditional investment wisdom to address his psychological needs. Financial experts often recommend strictly logical approaches based on time horizon and risk tolerance, but David recognized that his psychological comfort was equally important to his long-term success. The best investment strategy isn't the one that looks optimal on paper. It's the one you can actually stick with through good times and bad, he observed. By his early 50s, David's portfolio had not only recovered but significantly surpassed his pre-2008 assets. The preservation bucket provided stability, the income bucket generated growing cash flow, and the growth bucket, bolstered by strategic crash fund deployments, delivered impressive long-term appreciation. The results speak for themselves. By age 57, David had accumulated enough to retire comfortably, 5 years earlier than his original goal. His portfolio had grown to 7 figures despite starting over in his mid-40s with almost nothing. Perhaps most remarkably, during the COVID market crash of 2020, David didn't experience the anxiety that plagued him in 2008. Instead, he saw it as the opportunity his crash fund was designed for. While global markets plummeted, David methodically deployed his cash reserves, purchasing quality investments at what he recognized were temporary discounts. When the pandemic hit and markets collapsed, my colleagues were calling me in panic, but I was actually excited, David recalled. My crash fund was ready, and I knew exactly what to do. The crash fund wasn't just a financial tool, it was psychological armor against fear-based decisions. The one investment approach that worked for all three heroes. Despite their unique circumstances, what if I told you that Charlotte, Marcus, and David all eventually embraced the same core investment strategy? While their crash funds, dividend approaches, and recovery techniques were tailored to their individual situations, underneath these personalized layers was a surprisingly simple foundation that powered their remarkable results. These three ordinary people with wildly different backgrounds didn't just stumble into investment success. They each independently discovered the power of index fund investing. But why did this particular approach work so well for a single mom, a delivery driver, and a teacher rebuilding after disaster? Let's pull back the curtain on what initially seemed like three distinct investment journeys. When Charlotte first started investing alongside her debt payoff journey, she experimented with individual stock picking based on companies she knew and used. After 6 months of research-intensive evenings and disappointing returns, she discovered low-cost index funds that instantly simplified her approach. I was spending hours researching companies I barely understood, Charlotte admitted. When I switched to index funds, I got better results with almost no ongoing research. It was like turning on autopilot for my investments. Similarly, while Marcus became known for his dividend strategy, few realized that 70% of his portfolio was actually comprised of broad market index funds. The dividend portion was built on top of this solid foundation. My core index funds were the workhorses, Marcus explained. They provided the stability that allowed me to experiment with dividend stocks without risking my entire financial future. David, still nursing financial wounds from 2008, initially tried timing the market with tactical asset allocation strategies recommended by financial newsletters. After watching these complex approaches repeatedly underperform, he embraced a simple portfolio of just 3 index funds. What made this approach so universally effective across these different life situations? During market downturns from 2008 to 2023, index funds consistently outperformed the majority of actively managed funds. This simple approach delivered superior results while requiring minimal ongoing management, perfect for busy people focused on living their lives rather than becoming investment experts. 4. Charlotte. Her portfolio eventually settled at 80% broad market index funds with 20% in targeted index funds focused on areas she understood well, like technology and healthcare. This 80-20 allocation gave her the perfect balance of reliable performance with the satisfaction of some personalized choices. Marcus maintained his 70-30th split between index funds and dividend stocks throughout his journey. While his dividend stocks provided the psychological satisfaction of seeing cash flow arrive regularly, the index fund core provided most of his total return through appreciation. David's approach was the most conservative, with 90% in a simple 3-fund portfolio consisting of a total U.S. stock market fund, an international stock index fund, and a total bond market fund. The remaining 10% became his strategic crash fund for market downturns. The beauty of these index-based approaches was their ability to evolve with each investor's changing circumstances. When Charlotte's income increased, she simply increased her automatic contributions without needing to redesign her entire strategy. When Marcus wanted to focus more on income generation, he gradually adjusted his allocation without disrupting his core holdings. Each investor initially tried more complex approaches before embracing indexing. Charlotte experimented with picking stocks based on companies she used daily. Marcus attempted to time sector rotations based on economic cycles. David paid for expensive newsletters promising to help him beat the market with perfectly timed trades. In every case, these complex strategies produced worse results while consuming more time and creating more stress. The switch to index-based investing marked a turning point in each journey, better performance with less effort and anxiety. For Charlotte, the moment she knew her strategy was working came during the 2018 market correction. While her coworkers panicked about their 401k balances, she calmly increased her contributions, understanding that her broadly diversified index funds were now on sale. Marcus's confirmation came while comparing notes with a friend who had been following an active trading strategy. Despite the friend's countless hours of research and hundreds of trades, Marcus's simpler approach had outperformed by nearly 4% annually over 5 years. David's clarity arrived during the pandemic crash of 2020. After watching his complex strategies fail him in 2008, his straightforward index approach allowed him to stay fully invested through the downturn and recovery, dramatically accelerating his path to early retirement. What made this approach particularly powerful was how it accommodated each investor's psychological needs while delivering superior results. Charlotte needed simplicity that wouldn't add stress to her already demanding life. Marcus required enough engagement to keep him interested while preventing destructive tinkering. David needed an approach that could rebuild his confidence without triggering painful memories of 2008. The index-based foundation delivered on all these needs while outperforming more complex alternatives. It allowed each investor to customize around the edges while maintaining the core principles that drove their success. Charlotte gradually increased her international exposure as her confidence grew, eventually reaching a 70/30 U.S. to international allocation that optimized her returns through currency diversification. Marcus maintained a higher allocation to U.S. companies, but used specialized index funds to target specific sectors with strong dividend histories. David kept his international exposure limited to 20% of his equity allocation, reflecting his greater comfort with U.S. markets after his 2008 experience. These personalized adjustments around the core index strategy allowed each investor to feel ownership of their approach while still benefiting from the proven performance of broad market exposure. They each found the perfect balance between optimization and simplicity. Perhaps most importantly, this approach freed them from the constant information overload that paralyzes so many investors. Instead of chasing the latest hot stock or sector, they focused their energy on consistent contributions and occasional rebalancing, activities that actually drive long-term results. When Charlotte received a promotion and 15% salary increase, she immediately directed the entire increase to her investment contributions rather than upgrading her lifestyle. Marcus automatically increased his contribution percentage with each annual cost of living adjustment to his salary. David redirected money that previously went to financial newsletters and trading commissions directly into his index funds. This consistency in the face of market volatility separated our three heroes from average investors. While headlines screamed about market crashes and economic uncertainty, they simply continued their regular investments, allowing dollar cost averaging to work its mathematical magic over time. Of course, this approach wasn't without challenges. Each investor faced moments of doubt when more exotic strategies seemed to be outperforming during certain market conditions. The key to their success was understanding that short-term performance comparisons are meaningless against their decades-long investment horizons. Charlotte's sister-in-law bragged about cryptocurrency gains that dwarfed Charlotte's index returns in 2021. Marcus watched some of his delivery driver colleagues strike it rich with meme stocks during the GameStop frenzy. David's teacher friends were temporarily outperforming him with sector-focused funds during the tech boom. Yet in each case, our investment heroes recognized these as temporary deviations rather than sustainable strategies. They understood that investing isn't about finding the strategy that performs best over any short period, but rather the one that reliably compounds wealth over decades while allowing you to sleep at night. Weathering the storms, how our heroes handled market crashes and setbacks. Speaking of sleeping at night, what would you do if you woke up tomorrow to headlines announcing the market had crashed 20%? For most people, this triggers immediate panic and poor decisions, but our three ordinary investors actually learned to welcome these volatile periods. They discovered that market crashes weren't disasters. They were rare wealth-building opportunities that only the disciplined few could capitalize on. Let's face it, market crashes are inevitable. From the dot-com bubble to the 2008 financial crisis to the pandemic crash of 2020, major downturns are a normal part of investing. The difference between average investors and our investment heroes wasn't that they avoided these storms. It's that they prepared for them and responded differently when they hit. When markets tumble, most investors make a critical mistake. They sell at the worst possible time. Studies show that the average investor underperforms the market by nearly 4% annually, primarily because of emotional decisions during volatility. Our three heroes took the opposite approach. Charlotte developed what she called her volatility fund, a dedicated cash reserve that sat untouched, waiting for significant market drops. Unlike an emergency fund for life's unexpected expenses, this money had one purpose: to buy stocks when everyone else was selling them. She allocated about 5% of her portfolio to this fund and created strict rules for when to deploy it. I trigger my volatility fund only when the market drops at least 15% from its peak, Charlotte explained. And I never use it all at once. I divide it into thirds and invest at different points if the decline continues. This approach paid off spectacularly during the pandemic crash. While her coworkers panicked as markets plunged 30%, Charlotte methodically bought into the decline. When her first volatility fund purchase was immediately down another 10%, she didn't panic. She made her second purchase. By the time markets recovered in the following months, her volatility fund investments had gained over 40%. Marcus took a different psychological approach with his Red Day ritual. Having noticed how market declines affected his emotions, he created a specific procedure to follow whenever his portfolio dropped significantly. First, he'd close all financial news and trading apps. Next, he'd review his dividend calendar showing upcoming payments. Then he'd calculate how the market drop had actually increased the yield on potential new purchases. Finally, he'd make a small additional investment, even just $50, to reinforce the habit of buying during downturns. On the worst market days, I don't just avoid selling, I deliberately buy more, Marcus said. It's like training a muscle. Each time I follow my Red Day ritual, buying during crashes gets easier. This counterintuitive approach transformed his psychology. While others saw red days as disasters, Marcus began seeing them as discount days. During the COVID crash, he increased his automatic investment amount by 50% temporarily, meaning he was buying more shares at lower prices, shares that would later pay him higher dividend yields for decades. David's approach was perhaps the most sophisticated. Having already lost everything once in 2008, he developed a counter-cyclical rebalancing strategy that automatically took advantage of market swings. Instead of rebalancing his portfolio on a fixed schedule like most investors, David rebalanced based on market movements. If stocks dropped by 10% or more, he would rebalance from bonds into stocks. If stocks surged more than 15%, he would rebalance from stocks into bonds. This systematic approach meant he was always selling assets that had become relatively expensive and buying assets that had become relatively cheap. The key is having rules written down before the crash happens, David explained. When everyone's panicking, you don't want to be making decisions based on CNN headlines. This approach served him particularly well during the COVID crash. When stocks plummeted in March 2020, his counter-cyclical rebalancing automatically shifted a significant portion of his bond holdings into stocks at dramatically reduced prices. When the market recovered, those newly purchased shares appreciated substantially, accelerating his path to early retirement. What's remarkable is how all three investors turned market crashes, events that derail most people's financial plans, into wealth-building opportunities. The S&P 500 recovered from both the 2008 financial crisis and the COVID-19 crash within a few years, rewarding those who stayed invested or, better yet, bought more during the downturns. But market crashes weren't the only challenges our heroes faced. Each encountered personal financial setbacks that could have derailed their investment progress. Charlotte faced a sudden $4,000 medical bill that wasn't covered by insurance. Rather than liquidating investments, she temporarily redirected her investment contributions to pay off the bill over 4 months. This preserved her long-term growth while addressing the immediate need. Once the bill was paid, she immediately resumed her regular investment schedule and added 10% extra for 2 months to partially make up for the pause. Marcus encountered a more severe challenge when his delivery company downsized, cutting his hours by 30%. Instead of selling investments to cover expenses, he took on a temporary second job while reducing, but not eliminating, his investment contributions. Even during my toughest financial month, I still invested $50, he recalled. Maintaining the habit was more important than the amount. David faced a family emergency requiring extended unpaid leave from teaching. Rather than tapping his investment accounts, he accessed a low-interest line of credit secured by his home equity. This prevented him from selling investments during a market dip and preserved his long-term growth trajectory. Once back at work, he aggressively paid down the line of credit while maintaining his regular investment contributions. What united these approaches was the principle that short-term financial challenges shouldn't derail long-term investment plans. Each investor found ways to handle life's inevitable setbacks without compromising their wealth-building strategy. But how did they maintain this discipline when everyone around them was panicking? The secret was in their preparation before crashes ever happened. All three investors educated themselves about market history. They studied previous crashes and recoveries, understanding that downturns are normal and temporary. This historical perspective gave them confidence when others were fearful. They also removed emotion from their investing process through automation and rules-based systems. Charlotte's automatic weekly investments continued regardless of market headlines. Marcus's dividend reinvestment occurred without him needing to press a button. David's countercyclical rebalancing triggered based on preset thresholds, not emotional reactions. Perhaps most importantly, they reframed how they thought about market crashes. While most investors saw crashes as something to fear, our heroes saw them as inevitable wealth-building opportunities that come around only a few times in an investor's lifetime. The biggest market drops are actually when you make your most money. You just don't realize it until years later, Charlotte observed. It's counterintuitive, but the worst market days create the best buying opportunities. This perspective shift allowed them to stay calm when markets plunged. They weren't immune to fear. They just had systems in place to prevent that fear from driving their decisions. During the COVID crash, when the market dropped over 30% in a matter of weeks, each investor not only avoided selling in panic, but actually increased their buying. They recognized the rare opportunity presented by such a dramatic decline and had both the financial preparation and psychological fortitude to take advantage of it. By 2023, as markets recovered and reached new highs, the benefits of their counter-cyclical approach became clear. The extra shares purchased during downturns appreciated the investment heroes framework, 5 principles you can apply today. Their results weren't just luck or good timing. They were the predictable outcome of 5 specific principles that separate investment heroes from the investing crowd. What's fascinating about Charlotte, Marcus, and David is that they weren't following some complex blueprint designed by Wall Street insiders. Instead, they unknowingly tapped into the same fundamental framework that drives sustainable wealth building. The best part, this framework doesn't care about your current bank balance, education level, or financial knowledge. It's entirely accessible to anyone willing to implement it starting today. Let's be real, most investment advice you hear is overcomplicated and counterproductive. Time the market perfectly. Find the next Amazon before everyone else. Follow this complicated trading strategy that requires constant attention. This advice creates analysis paralysis and keeps most people permanently stuck on the sidelines. But our investment heroes followed a different path, a framework of 5 interconnected principles that anyone can adopt regardless of their financial starting point. Let's break down this investment heroes framework. Principle number 1. Consistency over intensity. The single most powerful force behind all 3 success stories wasn't market-beating returns or brilliant stock picks. It was unwavering consistency. While most investors obsess over finding the perfect investment, our heroes understood that how regularly you invest matters far more than what you invest in. Notice what happened when Charlotte maintained her weekly deposits even during market downturns. When Marcus increased his contribution percentage with each minor raise, rather than waiting for a significant one. When David rebuilt his portfolio through steady contributions rather than trying to make up for lost time with risky bets. You can apply this principle today by setting up a recurring investment of any amount, even $10 per week. The psychological power of automation removes decision fatigue and emotional interference. Remember, consistency compounds not just your money but your knowledge and confidence over time. Principle number 2. Emotional management systems. What truly distinguished our investment heroes wasn't their financial IQ. It was their emotional IQ. Each developed personalized systems to manage the psychological roller coaster of investing that derails most people. Instead of trying to be disciplined through willpower alone, they created external systems that protected them from their own emotions. Think about how differently they handled market crashes compared to the average investor. While others panicked and sold, they had predetermined plans that turned market volatility into opportunity. Start implementing this principle by creating your own emotional circuit breakers, predetermined rules for how you'll handle market drops before they happen. This might include a commitment to avoid checking your portfolio during volatility, a written investment policy statement, or a decision tree for different market scenarios. Principle number 3. Strategic simplicity. Perhaps the most counterintuitive principle our heroes followed was embracing simplicity when everything and everyone pushed them toward complexity. Financial media, investment platforms, and even well-meaning friends constantly suggested exotic strategies and complicated approaches. Yet all 3 built their wealth primarily through straightforward index-based approaches. They recognized that complexity often serves as a smokescreen that obscures poor fundamentals and increases costs. Their simplified approaches weren't due to lack of sophistication. They were strategic choices that increased their probability of success. You can apply this principle by focusing on a small number of broadly diversified, low-cost investments rather than trying to build a complex portfolio of individual stocks or specialized funds. Remember, your investment strategy should fit on a single note card. If it requires multiple pages to explain, it's likely too complicated. Principle number 4. Technology as a behavioral tool. Our investment heroes use technology not just for convenience, but as a powerful behavioral tool that reinforced positive habits and prevented destructive ones. They leveraged automation, visualization, and accountability features in ways that traditional investors often overlook. Notice how they didn't just use technology to execute trades. They used it to create distance between themselves and impulsive decisions. They set up systems that made good behaviors automatic and bad behaviors difficult. Implement this principle by auditing your current financial technology stack. Are your tools making good investment behaviors easier or harder? Consider setting up automatic investments that occur the day after payday, using visualization tools to maintain focus on long-term goals, and leveraging apps that provide positive reinforcement for staying the course. Principle number 5. Crash preparation as a competitive advantage. The final principle that united our investment heroes was their counterintuitive approach to market downturns. Instead of fearing crashes, they systematically prepared for them and used them as acceleration opportunities. Most investors view market downturns solely as threats to be avoided. Our heroes saw them as rare opportunities to acquire assets at discounted prices. This mindset shift, from crash victim to crash opportunist, fundamentally changed their wealth trajectories. Start applying this principle today by creating your own crash protocol. A written plan detailing exactly what actions you'll take when markets drop by 10%, 20%, or 30%. This might include increasing your contribution rate, deploying cash reserves, or rebalancing into assets that have fallen the most. What makes this 5-part framework so powerful is that it's entirely transferable. You don't need special connections, a 6-figure starting balance, or an advanced degree. You just need to start implementing these principles consistently. The most remarkable aspect of this framework is that it's entirely scale independent. Whether you're starting with $25 a week like Charlotte or rebuilding from scratch in your 40s like David, these principles work at any scale. They're just as effective for someone investing $100 monthly as for someone investing $10,000 monthly. Think of implementing this framework like installing an operating system for wealth building. The specific applications, investment vehicles, may evolve, but the underlying system remains stable and effective across changing market conditions. Want to put this framework into action? Here's how to get started today with lessons directly from our investment heroes. From Charlotte, begin with a minimum viable investment that's small enough to be sustainable but large enough to feel meaningful. For some, that might be $25 weekly. For others, it could be $10 daily. The exact amount matters, less than establishing the consistent habit. From Marcus, create a visual progress tracker that rewards consistency rather than performance. Track the number of consecutive weeks you've maintained your investment plan instead of obsessing over returns in the early stages. From David, establish a personal investment policy statement that outlines your goals, time horizon, and most importantly, exactly what actions you'll take during market downturns. This becomes your emotional anchor during turbulent times. From all three, surround yourself with the right influences. Unfollow accounts that promote get-rich-quick schemes and follow those that reinforce patient, consistent investing. The information you consume shapes your investing behavior more than you might realize. What single trait united Charlotte, Marcus, and David that you can start developing today? It wasn't specialized knowledge, natural talent, or extraordinary discipline. It was their commitment to building robust systems that made good investment behaviors automatic and bad behaviors difficult. The clock is ticking on your financial future. One of the most expensive mistakes you can make isn't what you buy, it's what you delay. Every day you postpone investing, compound interest works against you instead of for you. Think about this. The money you're not investing today could be doubling, tripling, or even quadrupling over time. This isn't just financial theory. It's the reality our three heroes embraced. They didn't wait for the perfect time or until they had enough money. They understood that time in the market beats timing the market every single time. Your journey might start small, a $10 daily investment, an automatic transfer on payday, or simply opening that first brokerage account. But make no mistake, 7 years from now, your future self will either thank you for starting today or regret that you waited. The question isn't whether you can afford to invest, it's whether you can afford not to. Which side of that